Good morning, everyone. Thanks for joining our webinar. We will kick off in about another minute or so as we give folks time to log in. Let's see. Can you hear us okay? Just shoot that out to Larry. Okay. Looks like we've got some folks in here now. All right, everyone. Well, welcome to our Income Lab webinar this morning, taking a deep dive into state taxes in retirement. Excited to have Derek Tharp and Justin here to present. And for anyone who this is your first time at one of our webinars, we will have the first half be presentations, and then we'll open it up for Q&A after. Inside the Zoom meeting here, you'll see a Q&A section where you can drop your questions in there, see other people's questions, like and move them up in our queue. And then after the presentation, we'll just work through the queue. This webinar is available for CFP CE credit. And so what we'll do is we have a survey that will go out right after the webinar so that you can give us your CFP ID and your information. So that way we can submit this for CFP approval for you. Outside of that, I will kick it over to Justin and Derek to get this started.
Okay, thanks, Mackley. And thanks everybody for attending. So today's topic is a little bit different from some of the topics that we've done in past months. We often focus much more on kind of the the analytics behind retirement income planning and dynamic planning and so on. Today we're going to focus on kind of one of the choices that retirees have to make in retirement. Certainly the kind of thing that gets every personal finance site has something on state taxes in retirement. Kind of assuming that this is just one of the inputs to that decision on where to live in retirement. Certainly, taxes are not always the top priority here. Often, family or weather or things like that would also weigh heavily on this decision. But for today, we're going to kind of strip all that away and just take a deep dive into state income tax. So again, actually, there are other taxes to consider, of course, when looking at where to live, including sales tax, property tax, and so on. But we're going to focus on income tax, in part because at Income Lab, we offer detailed tax coverage at the state level. And it's pretty interesting when you look closely at the state income tax systems. There's a lot there that is important for retirees. So that's what we'll be going over today, and sort of provocatively called this, is California a low tax state for retirees? The answer will be, it depends, but for some people, yes. In fact, there are even better examples than California of states that seem to be high income tax, but for at least certain retirees would be low or zero income tax states. So the outline is this: we'll spend a fair amount of this kind of mapping the true state income tax landscape for retirees. I actually have an article coming out. I'm not exactly sure when, maybe in the next month or so, that'll go through some of this as well. And then we'll look at some examples, look at the effective state income tax rates for a couple of example households and find some surprises there. And then wrap up with a particular strategy around income splitting in order to maximize state income tax savings in retirement. Okay, so let's start with the state tax landscape. So it's pretty common to see people kind of judging a state's income tax burden by its highest marginal tax rate. And so here you'll see 2021 top tax rates. It's actually a little bit different for 2022, but close enough. And it's pretty obvious to, if you take a second to think about this, that this is not enough information to know whether these would be high tax states for retirees, or frankly for anyone, right? For example, we would want to know what the rates are below this, assuming it's a progressive tax state, which all of the ones on the list here are. And then we would want to know the thresholds at which these hit, right? If it's zero tax until $5 million and then 13.3% in California, that would be worth knowing, right? And so we obviously want to take a closer look at what the state income tax experience of an actual retiree would be, and in a planning situation, what the tax experience of the particular household that you are working with would be before providing advice on state income taxes and the possibility of moving in retirement, at least in part because of those considerations. So the first place you'll usually see a look at state income taxes is just to focus on the states that have no income tax. And this list has actually grown slightly recently. So Tennessee used to have a small income tax. New Hampshire still has a small one, but these, for most practical purposes, New Hampshire is basically a zero tax state. And so we might just look at this and say, well, look, these are places where you could trim your income tax burden, right? Move to Florida, move to Texas. But in fact, there are more options than this for a lot of people if state income taxes are an important consideration. For example, and I apologize on this graph, I realized Alaska missed out on being blue, so I'll fix that before we send out the slides. But if we look at one of the core sources of retirement income, the sources of lifestyle funding, Social Security is not taxed at all in a lot of states. In fact, by my count, there are only 10 states that lack a blanket exclusion for Social Security income, whether that's because there's already no state income tax, or in the case of New Hampshire, this sort of taxes or this sort of income wouldn't be taxed, or because there's a specific exclusion. So really, it's the gray states in the mainland here that don't specifically exclude Social Security. And so if you have a household that is depending to a high level on Social Security income, you could easily have, $40,000, $50,000, $60,000 of Social Security income coming in. That is tax-free income in all of the blue and green states and Alaska. And so that goes a long way to lowering the tax burden for any given household. But even for the states that don't specifically exclude Social Security, there's still hope. So and this is probably a place where many of the advisors on this call have some expertise in your own state or in the states where you have a lot of clients. But there are specific exclusions to pension and retirement plan income that in many cases could cover all or most of Social Security for a state like Colorado, for example, where $24,000 per person is excluded from Social Security and pension or retirement plan income. New Jersey, which I think excludes Social Security separately. And that's the other nice thing about these exclusions. They generally apply only to 65 plus. Sometimes there's a slightly lower exclusion below 65. In a few cases, it's 59 and a half or some other age threshold. But these also tend to cover not just Social Security, but all sorts of other retirement income, whether that's pensions or withdrawals from retirement accounts and so on. So again, these can go a really long way to reducing the taxability of retirement income for a given household. As we'll see in some examples, in some cases where these are really hefty exclusions, this can effectively make quite a handful of other states zero tax. I'll point out a few of these in the examples to come. By the way, we will distribute these slides because a lot of this is very very in depth, and some some of these state exclusions can be quite have some interesting quirks to them. For example, in Georgia, I believe it is, the definition of retirement income is quite broad and can even include, wage income to a certain extent. In Rhode Island, on the other hand, strangely, IRA distributions are not, you can't get the exclusion for IRA distributions, but you could for a 401k, for example. So there are some very state-specific strategies one would want to know if you work a lot with clients in those states. For example, that particular piece in Rhode Island makes IRA rollovers less attractive in that state. There are also, as you'll know, in your own states, if there are specific exclusions beyond this, that many public pensions are excluded in particular states. I just picked on military pensions here because those are federal public pensions, and again, many states exclude this particular type of pension. Often, you'll also see within the state itself some public pensions, police, firefighters, teachers, may benefit from a certain amount of exclusion or a complete exclusion. The same goes for federal pension programs that are not military. We'll often see full exclusions or partial exclusions there. So again, if you have clients who worked in the public sector, you'll often they will often have much less reason to move to a tax-free state, a zero tax state, than they might if we didn't look more deeply into the specifics of state taxes. And again, it looks like Alaska got left out here. I think because it was in the lower left, I just wasn't seeing it. There's an additional piece. So this is on top of those retirement and age-specific exclusions that we saw on the last large table. States will often have additional exemptions and deductions, and in some cases credits that only apply to people 65 plus. And so just to review what the difference there, generally deductions and exemptions are essentially the same thing. So that's reducing the taxable income by some amount. Credits will reduce the tax bill by some amount. So sort of the value of the credit, if you wanted to compare it to the deduction, is a little bit more complex. It depends a bit on your tax rate. But as you'll see here, some of these, can be reasonably large. So for example, Maine, you have a $4,300 per person exemption, right? If we have two people over 65, we're adding that to those other exemptions and so on. Now we're accumulating ways to remove taxable income from the equation for someone living in those states. Some of these exemptions and deductions, and actually the same is true for the retirement income specific deductions, can be subject to phase outs at particular income levels. And again, we'll have a piece coming out in the next month or so that'll have a little bit more detail, sort of a way to have a reference piece on some of these, so that if you do have a new client, in a state you're less familiar with, you'll be able to kind of quickly understand what the retirement income tax landscape is for those individuals. There are also states that have special treatment of investment income. So mostly we focus so far on Social Security, pensions and retirement plans, but even things like long-term capital gains can be excluded to a certain extent in a small number of states. And there are even some other exclusions in certain states that I left out here just because they're so specific that they wouldn't apply in a lot of situations. For example, I think in Idaho, capital gains on cattle are excluded. Okay, so that's kind of the landscape. So we have total exclusions of Social Security in many states, exclusion of particular pensions, federal and state public pensions in a lot of states. And then we have a variety of exclusions of retirement type income, whether that's IRA and 401k distributions, retirement plan distributions, particular pensions, and so on. and a set of additional exemptions, deductions, and credits that are age-related. So the combination of all of those things has a large effect on your state tax bill. So let's look at them in practice. We might expect to see, again, that the states with the highest marginal rates coming out to have the highest effective tax rates for a particular household. But as I mentioned at the beginning, the highest marginal rate leaves a lot of information, unstated that would be really important to know if you were trying to figure out whether a state was going to be a high tax state for a particular household. So these are 2022 rates. So you may have noticed a slight difference from that first slide. But here, for example, California is still at the top. Hawaii, which we'll see in these examples quite a bit, has a very high top marginal rate, 11%. New Jersey we'll also see in here. New York. I think those are some of the states to kind of look out for in these examples, right? So we'll be asking, to what extent does the ranking of the tax bill for these households from an effective tax rate standpoint, to what extent does it match or not match this list of kind of headline high income tax states? Okay, so we've got two households. The first has a total of $75,000 of income, $36,000 in Social Security. And for all of these examples, I have split the income evenly between the couples, and you'll see why that is. But the outcomes here would potentially differ if there were not an even split of the income. In particular, if it was really lopsided, right? If all of this Social Security or all of this pension income were from one individual, you might see some large differences. So for this household, $75,000 total in retirement income, we have a zero tax bill in 25 states, and Alaska did make it onto the list here, and less than a 1% effective rate in 16 more. So that may not be surprising here because Social Security is such a large part of the income, almost half of the income. And we saw that a lot of these states are going to exclude that pension and qualified plan income, some of them to a high extent. Again, Colorado, 24,000 per person, Georgia, which we'll see an example here. I forget exactly what their 65,000 per person, right? So a lot of states we're just swamping this retirement income with exclusions and getting down to zero. But even in states where we haven't been able to exclude all of this income, there's a very low tax bill. And interestingly, as we sort of list out the states that have a greater than 1% effective rate for these folks, Utah is appearing to be the highest tax state at 3.1% effective. Massachusetts may be a little less surprising because it's sort of thought of as a high tax state, although that doesn't always come out to be true. And you'll also see Montana showing up in some other places here. Household B, we've doubled the income to 150,000. So here, 48,000 in Social Security, again, split evenly between the spouses. Again, some pension and qualified plan income. And here I've added an equal amount of investment income, all of it long-term capital gains. That's unlikely to be true, right? Probably if we're taking some money from a taxable account, at least some of that might be return of basis, but kind of stacked the deck against this family and made all of it taxable. So they have $150,000 of potentially taxable income in this case. And now we have only 11 states that have zero taxes. So we've really only added a couple to to our set of already tax-free states, you'll notice Georgia and New Jersey are green here, which is potentially surprising. But there are 3 more that are under 1%. So those are the blue states here, North Dakota, Wyoming, and South Carolina. But 13 more are between 1% and 2%, which are, again, maybe a little bit less than we might have expected. And we see states like Hawaii and California on this list as zero tax states. Again, I didn't call this out for household A, but that was also true for household A. So Hawaii and California, the top 2 states with regard to their highest marginal tax bracket or rate, are actually zero tax states for household A, and they're between 1% and 2% for household B. New York also, notice, zero tax for household A. New Jersey, still zero tax for household B for New Jersey, but between 1% and 2% in New York for household B. And again, if we kind of rank the worst for these folks, Montana, Utah, Minnesota, Oregon. Oregon maybe not as surprising because that was on the list of the higher tax states, but these are potentially fairly surprising, Montana and Utah. And really the culprit here is that those are states that, although they may not have the highest rates, may apply those rates at lower income thresholds and also lack some of these specific exclusions that we saw earlier, those retiree specific exclusions. This might be a good time to mention that the trend in state legislatures has definitely been toward more tax breaks for retirees. So for example, we saw the military pension exclusion map earlier. There has been the states that exclude military pensions, that list has grown recently. And there are states that are planning on phasing in more retiree specific exclusions. So that it's definitely kind of a watch this space area. We've even seen some states looking to phase out income taxes entirely over the next several years. So it's a dynamic area. These I would not expect these maps and numbers to remain the same as the years go on. But again, some surprises here, right? If this family were looking to kind of keep their state income tax bill low, they really have a lot more options than just the well-known zero tax states. Okay, so just some observations regarding these examples. So along with the zero tax states, Georgia, Hawaii, Illinois, I didn't mention them, but also thought of as a high tax state, New Jersey and Pennsylvania, often masquerade as zero income tax states for retirees. Again, depends a little bit on the household specific profile, but it's not hard to find a profile where these states would be zero tax states. The more a household depends on Social Security and pensions or qualified plans, the higher the likelihood they may have to pay zero state income tax. And this is actually an interesting place where having this kind of tax deferred money does actually have a slight tax advantage over having taxable accounts. Again, you'd have to look at the exact situation to know whether that's a large enough advantage to make the qualified plans more attractive than a taxable account. And some states like Utah and Montana may have a comparatively higher tax burden for retirees than one might think from just marginal, the top tax bracket. Okay, so now we'll turn to some actual strategies for maximizing the exclusions of retirement income in states, right? So this is maybe a little bit less about helping people figure out where to move, and a little bit more about the tactics in any given year, or even the tactics in saving for retirement. So this is also a place where your savers might start to think a little bit about, when they have opportunities to save money in one way or another, how they should do that. So we'll focus here on states that have what I'll call a per spouse retirement income exclusion. And so these are the yellow states, right? So these are states that have a state income tax and also have retirement income exclusions of the sort that we saw before, whether that's 401ks, 403bs, and so on, IRAs, pensions, even private pensions, and so on. And these are states where those exclusions apply per person, meaning, for example, look at Colorado, where I am. A 65-year-old gets a $24,000 exclusion. And so, the most obvious place is, well, if I'm 65 and my wife is 60, well, she would get a $20,000 exclusion, I'd get a 24, but we don't get to combine those and just say, well, we get $44,000 excluded from our income. It's almost like we're doing our taxes separately, right? So my Social Security, my, retirement plan distributions, and then I apply that $24,000 to my column there, right? And so it's easy to see that, in Georgia, for example, we would have the potential of excluding $130,000 of retirement income, which is quite a bit, especially given that Georgia also excludes Social Security. But if not used judiciously, we would miss out on some of that exclusion. So I've used Georgia here as our example. We have Jack and Jill. Let's say they have $140,000 of total retirement income, but that all of it is essentially in Jack's column, right? So maybe it's all 401k distributions. Only 65,000 would be excluded from taxation, leaving 75,000. On the other hand, if this were more evenly split and 65,000 of that were in Jill's column, they as a family would only have $10,000 left net of the exclusion. So 75,000 versus 10,000. So a really major difference in how things are apportioned there. So the first piece is to know here is just to be aware of, are the states that you're planning in income splitting states? And if they are, how important are these exclusions to the family that you're planning for? If it's both an income splitting state and that exclusion would be important and having meaningful effect, all else being equal, we would want to plan to fill up these exclusion buckets for each spouse. Now, if there's plenty of assets in both spouses' name, let's say there's a lot of 401k assets, in any given year, we'd want to make sure that we're at least filling up those exclusion buckets, all else being equal. If we're still in a savings period, crafting a retirement savings plan that could produce retirement plan funds for both spouses, if they're retiring in an income splitting state, is something to think about now, right? So this might be a situation, even if the spouses have very different wage levels, for example, you might do very large exclusions for even the lower income spouse in order to make sure to have those assets available for income splitting later. As I mentioned earlier, it is also important to watch out for specific rules like exclusion of IRA distributions and the impact of excluded Social Security income. So there are some states where these exclusions can kind of be eaten up by Social Security. Colorado is one of those states where that $24,000 really first applies to Social Security. So if this family would have high enough Social Security that would be eaten up, the income splitting is a little bit less important, assuming that the Social Security is evenly split, right? This is also a place where there's some impact related to Social Security timing, and even thinking about RMDs and Roth conversions, right? So the splitting of these things, if say, for example, one spouse had a very, very large retirement plan balance, there may be a reason that we want to, bring that balance down more quickly in certain situations. Okay, so kind of to summarize this, we've seen that top tax brackets in a state are really a poor measure of the state's income tax burden for a retiree. This is a common theme in a lot of our webinars, is that rules of thumb are not particularly useful when it comes to planning for a specific case, a specific example, a specific household, right? The idiosyncrasies of a particular plan can really have a large effect and make those, rules of thumb even completely wrong in certain situations. So we have to look beyond kind of the easy numbers. Only 10 states lack a blanket exclusion of Social Security, so that already has a large effect on state income taxes. There are numerous age-based or source-based exclusions to help retirees. So these would be the over 65 exclusions, deductions, and credits, and also the exclusions of income that is retirement type income. So it's pensions, IRA and 401k distributions, and so on. And because of these, the effective rates for a particular household in a particular state could be quite low, even if the state has an income tax, and even if that income tax could potentially be very high for certain people, especially people who are in their working years. So states like California and Hawaii can even be zero tax states for certain people. The specifics of the household has a significant effect on their state tax situation. So this is why, one of the reasons why at Income Lab we've focused on providing in-depth coverage of state taxes, so that you're able to give a household a feel for, well, maybe you are considering a move to some state. Maybe it's even a state that you think might be high tax. Here's a way that we can provide some estimates of what your actual tax situation would look like. And in general, we've seen that often the news is better than someone might think if they're just thinking about kind of top marginal rates, or just the more superficial look at a state's income tax system. So with that, I think we can open it up to questions. Or Derek. Oh yeah, Derek, you are here. I think if you have some comments first on kind of how you plan. I know you have clients in several states, so just some thoughts on state tax planning.
Yeah, I mean, I think for me, kind of a big, whatever tool I'm using, right, it's helpful that it is giving me something accurate that I can kind of rely on to guide my clients and give them advice. And so that's a big deal for me. I don't want to recommend a particular strategy or a move or whatever that, or talk to the tax implications of the move without really understanding what's truly there. And there is so many layers of complexity at the state level, particularly when you have clients that are looking outside of the state that you're most familiar with, or multiple states. So for me, that's useful. I think another practical tool is right there, or consideration is that like the planning software, getting the broad strategy right. Like, to me, I realized that there's so many complexities for every single situation. A lot of times it's not going to be 100% there. And there are times when I'm going to move something over to another software program, like a holistic plan. Sometimes if I'm trying to get like really into the weeds of like a single year, if we're looking at Roth conversion or something else like that. But that to me is kind of how the two tools like that work together, where Income Lab helps me set the broad strategy, make sure I'm making a good general recommendation long term, right? You can't really, in tax prep or tax planning type software, you really can't do a lot of those long term projections to say, does a Roth conversion, does that add value over time? So getting the strategy right there, and then doing a deeper dive, if I need to, into the nuance of somebody's situation, and especially if there's stock options or other sorts of complexities that might come up. So that's just in practice, how I personally use those two tools in tandem. But yeah, definitely accurately accounting for the state level information, at least the big stuff, is very important.
Yeah, I think that's an interesting point about kind of looking long term. So like at Income Lab in the tax center, we have ways to kind of rank different strategies, looking at the projected taxes out over time. And I've thought a lot about how hard it is to actually come up with rules of thumb or sort of an easy flow chart on, okay, well, if this, then this, because each moving piece affects the other things. So Social Security claiming can affect state taxes, which, and also your Roth conversion strategy, even Medicare claiming, right? So when you're retiring, maybe retiring later pushes Medicare out, which might get you over some IRMA years, right? So everything is so interrelated that it's important to have tools like that you can kind of look out at a broader picture of each kind of situation, so you can do A/B testing on those ideas.
Yeah.
Malkley, do we have
we have one in the chat, but for everyone else on the webinar, please drop your questions in our Q&A section and we'll start working through them. The one question that came in the chat is, how did these states compare when you factor in state tax and property tax?
Yeah, it's a good question. There are some, it may have sounded like I was kind of saying some of these more, personal finance websites might be a little superficial on some of these, but actually I did find some that were quite good on kind of covering a little bit of the broader tax picture. So not just income tax, but state taxes and property taxes. So depending on the situation, right? Again, that could also be an important consideration for the couple. But yeah, I mean, I've not done a deep dive on those issues. There are some states, that do have higher taxes on an income level, but for example, lack of sales tax. So Oregon is a well-known example of that. In fact, I know there are a lot of people who live in Portland or just across the Columbia who will strategically live and buy in different states, right?
Yeah, I would just add to that. I mean, that's definitely when you want to be doing a deep dive to what is your client actually looking at, and taking that into consideration, because there are some found organizations and stuff that do like the general tax burden overall and try and blend numbers in terms of total tax burden in a state, but I've never seen one personally that accounts for all the retirement specific considerations that Justin's talking about here. The measures I've seen have just been general, so you're going to get the typical earner type, somebody who's in their accumulation years tax burden. Would be interesting to see somebody kind of update that holistic view, but I don't personally know of any to point somebody to.
Let's see here. I have questions coming in. And last in the chat, someone did comment that also multi-state tax credit for resident states should be considered.
Like if you're working in a different state.
Mm-hmm. Let's see. So on a different subject, can you walk through some talking points for the historical analysis page in the household plan? It seems to be helpful in these down markets. What is the best way to explain this page?
Sure. Pull up an example as we're here. So the historical analysis page is really saying, well, we don't know the future, right? And that is one of the things that makes retirement income planning so interesting, so difficult. So it's one of the reasons that we really need experts here. But we do know the past, and so the past can allow us to paint a picture of how things have been for particular individuals over time. And so the historical analysis page is really saying, well, what if instead of April 2022, this exact household with we're about to embark on your plan, and we actually knew the future, right? We knew exactly what you were going to experience. Well, the historical analysis page shows what you could have done, right? And so I'm almost there. Zoom definitely likes to take up some of my computer cycles here. So it's basically, instead of talking about probability of success and failure, it's trying to provide context that someone can actually understand for the advice that you're giving them, right? So here's an example where the black line is the proposed income. The green line is, the total income in their budget, or the total spending that they want in their budget, grossed up for taxes in this case. And the kind of magenta line is their essential income, right? This is going out the door every month, no matter what. So it looks like for these folks, the advisor would be able to say, well, actually, I think you can afford a little bit more than your budget, right? That would either allow them to spend more if they'd like to, or just allow them to say, wow, we're doing great, right? Because on the green line, for example, it looks like never in history, even back in the early 20th century, which is longer ago than any of us can remember, but also in the 60s and 70s, which are kind of the most recent bad time for retirement, so to speak. No one would have failed to be able to spend at their total budgeted level, right? So whatever the probability of success or failure would be if you did this plan in kind of a more static platform, this provides context saying, we don't know the future, but in the past, this particular spending level was fine. There were no problems whatsoever. Even the proposed spending level, in this case, would have survived through the 60s and 70s, which were a period when the available income, because of sequence of returns and inflation and so on, was fairly low. It would have survived even the worst point in the Great Depression, right? Survived meaning if they had been spending at this level, they would not have had to reduce their income. And the only time that it would have required a reduction would have been in the early 20th century. So you can dive into particular historical periods, for example, World War II and the Great Depression, and say, well, look, could the future be worse than the past? Of course it could. But let's look at some periods we know were, pretty bad, pretty scary in the past, and compare what I'm recommending to you to those periods. So again, it looks like in this case, even the proposed income is actually slightly lower than the worst period in the Great Depression. Also on this chart, you have the ability to say, well, look, for this household, what could have been achieved historically varied hugely, right? I mean, in June of 1980 here, they could have spent almost $28,000 a month, but back in July of 1968, it was only $17,000. Huge variation. Which of these should I kind of take more seriously, right? Do we feel like we're in one of these top periods or in one of these lower periods? So the blue shading is shading periods that were more like today in economic terms. So we're talking about stock valuations, interest rates, inflation, and so on. And so this, you can see the blue is generally shading periods with slightly lower income than the gray. The gray includes some of these big peaks in income that were only available in periods very different from today.
I might just quick add to that too. When I'm showing this to a client, the thing that I'm really, most of the time, the high level takeaway I'm trying to get at is actually how conservative of a plan we're projecting for them, and trying to give some confidence just around, here we can look back to some of these tough times in history. We can see, even in those cases, the client may not have need to cut back much, or maybe just would have had to cut back a little, and really have a conversation around that. And of course, it's not always that way. If you set a more aggressive set of guardrails, you would see that there would be substantial periods of time where you might need to cut back. And so, but a lot of times I'm not just personally getting much farther into the weeds, other than, maybe highlighting, like Justin's done here, a few particular time periods and that, but really just trying to focus on, relative to history, is this a conservative or an aggressive type of plan? And at least in most cases, the plans I'm running, they do tend to be fairly conservative, and then talk about that upside that then comes with that.
Yep. Yeah, I think this is one of those places where people, just knowing that, okay, this would have, you would have been able to live through the Great Depression, 1929 on. 1929 was a pretty bad time here because you had 29, and then I think it was also 34. There was another big crash. So, that's a pretty dire period, which is also when people say, well, what if the future is worse than the past? That's a perfectly good question, and it certainly could be. But let's remember, there actually are some pretty bad times in the past, right? So it'd have to be worse than those times, right? Not just worse than recently. Recently, certainly things have since the financial crisis, stock markets have done great. But this is kind of, a way to provide context that is based on something someone can grasp, right? Rather than just sort of hypothetical abstract statistics, right? So I think this is part of painting a more concrete picture for someone around what the retirement plan that you're outlining for them really is like.
It looks like there might be one more. Oh, Malcolm just answered it. I was going to say we can answer that question, but it looks like they're updated every month. So.
Yeah, these are updated every month. And the other thing to keep in mind here is this chart is specific to the plan you're looking at. So if this is a 10-year plan or a 40-year plan, it's different. If it's 80% stock or 20% stock, it's different. If it has the smile or doesn't have the smile, it's different. So this is not like a static, everybody sees the same mountains. Often you will see, higher periods in the 80s, higher periods in the early 20s, but not always, depending on what the particular plan looks like.
Next question, back to the tax topic, is would there be more functionality for an advisor to do more A/B testing other than just changing, copying a plan and changing the state of residence? If the advisor wanted to project out, for a client who, let's say, is moving from New Jersey to Florida at a certain date in the future, can you speak towards kind of the functionality there to help advisors do that type of scenario? Yeah,
it is a really good idea. It's not currently possible in the software. Like you said, what you can do is A/B test one state versus another. But I like the idea because, especially if you're planning kind of pre-retirement, okay, well, we'll have some taxes for a few years in New Jersey and then in Florida and so on. I think it's definitely something we could consider adding that functionality.
And then next question, more two comments, but Brett wanted to point out that he really thinks you guys are on the right path. So thanks, Brett. Love that feedback. And he said it sounds like you guys read J Painting with Numbers by Randall Bolton. I don't know if that's familiar to you, but we'll take a compliment.
Yeah, I'm not familiar with the specific, but I do. I'll definitely look into it. Sounds interesting.
And then let's see, any other questions here for the folks on the webinar or comments? Give them another minute. And while we're waiting on another question to come in, just a reminder that after this webinar, as soon as we close this webinar, Zoom should take you to a browser where you can quickly submit your name, CFP information, so that way we can submit your information to CFP for your credit. You'll also get a follow-up email from Zoom after the email to be able to submit that information as well. If you didn't get either of those, we will send a follow-up with the recording link in the slides, so you can always reply back to that email from us directly with that information. And outside of that, oh yeah, there.
One question that might be helpful just for discussion on the topic, but like if somebody wants to go and see that state specific tax, do you have a way to easily show us where they would do that?
So I'm working on an article for KidSys. I think it should be out in the next month or so, where some of that'll be. I think we have a all of that glorious, complicated stuff in kind of a table form, and we may sort of create a PDF of that. Might have to be bigger than a letter size piece of paper, but that kind of people could keep on their computer, understanding that as the years go on, that'll may not age well, but I think we'll put that out there for people.
Perfect. Well, Derek and Justin, as always, thank you both so much for taking the time to run the webinars, bring up cool content for our advisors, and help with any questions. For our users, thank you for joining. Stay in touch for our next webinars coming up next month. And again, please respond back with your information, with your CFP information, so that way we can make sure we submit that for you as well. And last thing, just to be clear. Oh, perfect. You got that, Justin. Awesome. All right, guys. Well, thank you so much. And then we will send out the recording link and the slides. If not later today, then tomorrow. All righty. Well, thanks so much, everyone. Have a good day. Bye, guys.